afternoon, I guess, to some, and good morning to others, I guess. It's still a little bit morning here. I'm in Mobile, Alabama. Welcome. My name is Geoffrey Smith. I'm the Chief Instructor here at DTI. I want to kind of go through trading in the first hour and kind of swing trading stock a little bit. You'll probably hear this a lot today, but there is risk in trading. And of course, past performance is not indicative of future results. The one thing about trading is that losing is part of the game. And the thing is to manage your losses and try to maximize the gains, of course. But we do have to expect to lose at times. We cannot be 100%. So, and you'll probably hear that a lot today as well. I'm not the best typist in the world, so if you do see a typo, let me know. You know, I click a mouse a lot. You know, I do trade, but and when it comes to typing and things of that sort, you know, my fingers kind of get tied up every now and then. So just let me know if you do have a question about something that I've typed in here and stuff like that. As we just stated, I've been trading for 25 years-ish, maybe a little more, maybe a little less. I started back in 1985. My father went through the School of Hard Knocks, and he didn't want his two boys, my brother and I, to have to do the same thing. So regardless of what field we went into, he wanted to make sure that we had some sort of a financial background. So he actually made us read all kinds of newsletters and all this stuff, papers about financial stuff. I literally couldn't go out on some Friday nights unless I passed one of his little quizzes that he had me read or something like that. Drove me nuts. But anyway, he sent us, he actually had a stockbroker. His name was Tom Busby, and he was Vice President Smith Barney in Oklahoma City, where I'm from, and asked him if he'd kind of help him a little bit. So we went down and spent some time in his office. Once we'd done that, he sent us to an investor boot camp in Provo, Utah, put on by a gentleman named Howard Ruff. Some of you might have heard of him. He used to have a newsletter called the Ruff Times. Anyway, we went through that thing and got back, and he sat us down, wrote us each out a check for $10,000 put in the stock account, told us we could make money with it or not, but he'd never give us another dime, and he stuck to his word. Went to University of Oklahoma for a couple of years and transferred to Oklahoma State, graduated with a mechanical engineering degree, and then got a master's in engineering, industrial engineering. When I kind of graduated from there, I started kind of dabbling in the old markets and things of this sort, trying to figure out what was going up and down. I bought some stocks, got into currency bonds for a little while before the 90s. Once the Globex system kind of came through in 92, started trading index futures, getting up about 3 o'clock in the morning, trading up to about 6:30, going to work all day. So I spend about an hour or two every morning seeing if we can make a little money before we get to work. Did that, of course, then got into trading options and stocks a lot heavier and index futures early in the morning throughout the 90s. By 99, 2000, I was in management. Tom Busby had started a school here in Mobile in 1996 and asked me to come down and help him teach. I liked my job too much. I told him no, turned him down a couple of times. But the market at that time had become a hobby of mine. I was really intrigued on how it moved around and worked and things of this sort. Finally, in 2000, he asked me to come down here, and I guess I had a bad day. I was just a babysitter at that time, wasn't really doing in engineering or anything like that. So I packed up my family out of the panhandle of Texas and moved here to Mobile and been teaching and trading ever since. So I've traded in just about every market out there, have not traded every vehicle by any means. But anyway, that's just kind of a real brief bio of myself, so you kind of know my background. DTI, the Diversified Trading Institute, is a training facility. We teach people how to trade in various markets, stocks, options, futures, commodities, currencies, bonds, whatever it may be. Of course, we have online and live classes. The little picture you see over on the right side is kind of a skewed little class. So we actually have a kind of a stadium-style classroom that we teach people in. I just finished a class yesterday, actually. We have our own live trade room that is a 24-hour trade room. Now, not somebody's in there talking 24 hours a day, but we have students from around the world that, regardless of what what time it may be. They can go in there at any time and see what the markets are doing and things of that sort. We have our own software. It's our roadmap software that's designed around our method, but there are a lot of things that other people probably have, will recognize and things of that sort. But it is a way to track the markets 24 hours a day. And of course, we do have our continuing education for our students. So what I want to kind of walk through here throughout our morning, and we only have like an hour or so, so I'm going to be really pressed for time because I mean, I really like the markets, I really get into markets, and I can talk about markets all day long. So we're going to have to compress some time here. But I want to go through our method a little bit so you got to kind of a little bit of understanding of what I'm looking at. Then I'm going to start talking about trading some futures around 8:30 in the morning. That's Central Time, by the way. Everything I do is in Central Time, so if you need to adjust to that, please do. Right now it's 11:23 a.m. Central Time, so there it is. And then I want to kind of go through a strategy for swing trading stock using options. It's a pretty simple strategy, but it's a real great way. I mean, the previous presenter that I heard him when I just logged in was talking about, what are all traders trying to do? And basically manage risk. Well, people look at risk reward a lot differently, and we'll talk a little bit about risk reward once we get there, just kind of give you an idea how you should probably really look at it as opposed to the way some people do. When we start looking at our 24-hour clock, I mean, this is a global marketplace. If you've ever looked at, the index futures or even heard on CNBC or Bloomberg, the futures are pointing to a higher open, or we're 6 points below fair value. They're looking at index futures, and index futures are a derivative of the cash index. There's a problem with the cash index. The S&P 500, the Dow 30, the NASDAQ 100, or the NASDAQ Composite, whatever you want to look at there, is that it starts up at 8:30 in the morning a.m. Central Time, and they turn it off at 3 p.m. Central Time. That's 9:30 Eastern to 4 p.m. Eastern. So you have 6.5 hours out of a 24-hour day that the cash indexes are actually calculating. Well, those indexes can only move if the stock's inside of a move, right? I think everybody gets that little gist there. So the thing is our stocks trade around the world. Just like here in the United States, we can trade Potash or Alibaba or Baidu or the Toyota Motors or whatever it may be. We can trade these stocks on our exchanges here. Well, you can turn on like Bloomberg in the morning and see our stocks trading in Europe, but yet our cash indexes aren't moving. But our stocks are moving around the world, but the cash indexes aren't moving. So we have to try to figure out some way to figure out what our stocks are doing around the world. And we can watch a derivative of the cash index. It's an index future, and it trades virtually 24 hours a day. So when we're getting off work here in the United States, Asia is opening up. Right now, since we just went through daylight saving time, you have the Nikkei, Japan markets, opening up at 6 p.m. Central Time. You have the Hang Seng, Hong Kong markets opening up at 7:30 Central Time. So by 7:30 in the evening, you have all of Asia open and trading. In fact, if you want to know, New Zealand's the first market to open, and they'll be opening up at about 4 p.m. Central Time. But we start our 24-hour market at 5 p.m. Central Time. And we've taken this 24-hour market and divided it up into 4 separate time segments. Each time segment literally is its own day. Just because Asia's up doesn't mean Europe will be. Just because Europe's up doesn't mean we will be. We can kind of track to see what our stocks are doing throughout the world. And so we start looking at Asia in our evening time. Of course, when we go to bed, they're at lunch. When we wake up early in the morning, depending on when you wake up, you have the European markets actually taking control of the markets. Now, the European markets actually open up at 2 a.m. Their cash markets do. But they have a lot of economic news that comes out between 3 and 4 o'clock in the morning, so we want to see what that trend is off of that move. So we'll start looking at that time segment about 3:30 in the morning up until our markets open here at 8:30 a.m. Then we'll get the ding, ding, ding here at 8:30. We'll have our morning session where Europe is still trading with us. They actually are trading with us in our first 2 hours. We'll go to lunch. When we come back, we have our afternoon session where it's just the Americas, North, Central, South America, that are open and trading. And then, of course, we end our 24-hour day. We take about an hour break. grab something to eat, whatever, and then the ding, ding, ding starts up again at 5 p.m. and off we go. So it's a really busy 24-hour day. So we have to find out when we want to sleep and eat and spend time with the family and things of this sort. So, but it's quite a busy little day. We have something called a reference bar, and you'll notice the times here when we were looking at the previous little slide here. We have these 4 separate time segments. One starts at 5 p.m., one starts at 3:30, one starts at 8:30, one starts at 12:30. Well, you have the 4 reference bars, which is the first 30 minutes of each one of those time segments. It's an opening range, basically. And what we're trying to do is see how the open of each of these time segments performs. Then if we start breaking higher, of course, we're much stronger. If we start breaking lower, we're much weaker. And so we can use these 4 different time segments and these 4 reference bars to help guide us through each of those individual time segments. But they're just basically a 30-minute range, and you'll find that we use 30-minute charts on an intraday basis anyway. But we can use those to kind of help A, find market direction, B, find entries, and also place stops and things of that sort. I made a little picture here of the reference bars, kind of give you a little taste of what kind of looks like. You'll notice we paint those reference bars blue. This is a candlestick chart where we have the green bars that are moving up. We have red bars that push down. But these blue bars are actually the open of each of those time segments. So you have your reference bar 1 on the far left, and that's the Asian time segment that kind of pushed it up beginning, kind of drifted off a little bit. We got to the European time segment that continued that trend down, broke the low of that, continued down. We got to our morning market here, and of course we reversed that trend. We took out the high, went higher. Even in the afternoon, we went a lot higher, but then they kind of corrected things back a little bit. This is actually yesterday's market if you're trying to figure out what day this is. But this is how we performed yesterday. You actually had a flat Asian market, a down European market, and an up U.S. market. And then we kind of ended the day. But we have each one of these individual reference bars to help guide us through each of one of those individual time segments. So when we start looking at the S&P futures and start looking at just overall market direction, you'll find that we don't look at the cash indexes a whole lot. You can't trade it, so why look at it? It's only going to move because the stocks inside of it move. Now you can trade a derivative of the cash index. You can trade the SPY, right? It's the spider. You can trade the S&P futures. You can do SPX options. You can trade derivatives of it, but you really can't trade the cash index. So we start looking at the S&P futures because, well, they trade 24 hours a day. The whole world gets to influence them. And if you think about, the cash index just being able to open up at 8:30 in the morning, closing out at 3, o'clock in the afternoon, I mean, how many times have you seen gaps in the cash indexes? A lot, right? So, yes, this is all in Central Time, Debbie. But when we start looking at these gaps, the question is it really a price gap? Because really it's probably not. It's probably more of a time gap. I mean, it'd be the same thing as if you're going down I-40 and somebody else is driving, I hope. But you fall asleep and you wake up in Oklahoma City 8 hours later and go, look, I gapped. And you really didn't gap. You traveled that whole distance. You were just asleep, right? And that's basically what the cash index is doing. They turn it off at 3 p.m. They open it up at 8:30 in the morning the next day, 17 and a half hours later. And yeah, there's probably going to be a gap in it because the world has moved around. And that's why we watch the S&P. It opened up the year at 2055 on the S&P. Now, right now we're trading 2097.75. And we'll talk about that here in just a second. But we opened up this week at 2073. Now, I just told you we were up here, 2098, so we're above the week open. And of course, this week's open is also the month open, which is 2073. We opened up last night at 5 o'clock when our 24-hour market started. That's that Globex open at 2102.50. We went up to 2109.75 last night. We had a low down at 2100.50. Basically 2100, and yesterday we went up to 2110 and had a low of 2089. So we didn't exceed yesterday's high. They went up real close to it, came within a half a point. I mean, look at that, 2109.75, 2110, didn't make it, but they haven't taken out yesterday's low either. So we're actually trading in kind of a tight little range here, but they are trading below this Globex low that we had. We actually opened this morning at 8:30 in the morning at 2107, which is pretty close to the highs up there. So what we can do with these opens and these highs and lows is kind of put them in numerical order and try to start figuring out where the market's trading. We're below every one of these except, of course, the week open, the month open, the year open, and yesterday's low. So we are going to have support down at 89 if we continue to move down. Then if they break below there, they're probably going to go challenge the week open or month open. And that's why we look at these opens to kind of get a better feel for how things are going. When we start looking at these numbers, we want to start comparing specific prices, and this works with any market. I just grabbed the S&P because it's kind of the big dog that's out there. But you can grab any market and gather the exact same numbers. And sometimes, I mean, even if you're looking at a stock, you're not going to have a 24-hour market in the stock. But you can look at the previous day's high and low, where it opened this morning, what its opening range is, and start figuring out, okay, where's this thing going to try to get to? Can it break above these highs or break above one of these other opens or break below these opens and start moving around? So, but we want to see how they're trading. Are they trading in the upper third of their ranges? Are they trading in the lower third of their ranges? Are they trading in their middle third of their ranges? We like to put things in thirds to say, okay, if we're in the upper third, it's a stronger market, lower third's weaker market, middle third's noise. And if we're trading in the middle third on something, it doesn't know where it's going, and probably we don't either. And that's the one thing that we are trying to do, is trying to figure out the answer to a question of long, short, or out, right? So if I'm in the middle third, I'm out. Upper third, looking long, not looking short. And if we're in the lower third, I'm looking short but not looking long. So if I can start eliminating one of those, I'm doing pretty good. And that's really what we're trying to do. You'll notice I've been talking a lot about opens. A lot of people use closes. I've never understood that. You know, when you start looking at the close of a market, you already know who won or lost. I've never been able to start the race at the end. I don't know about you. And I don't think people buy a ticket to like a football game to get there in the last second and go, wow, that's who won. When we're trading, we're trying to figure out who's winning, because we're trying to trade the future. We can't trade the past. Believe me, I'd love to go trade the past, but you just can't do it. So we're trying to figure out, how to make a decision right now. So we start looking at things from open. Are we above the open? Well, if we're above the open, bulls are in control. If we're below open, bears are in control. And this is where things can get kind of confusing a little bit to some, because if you think about this very quickly, if we're doing everything from open, that means we could, in the cash index, gap down from the previous day's close, right? So let's just use some numbers. Say we closed at 100. We open up the next morning at 8:30 at 95. But yet from 95, we could rally all the way back up to 99 and stop there. So from the open at 8:30 to the close of the day, we went up 4 points, right? But yet we're still below the previous day's close, so the news is going to say it was a negative day. But yet from open, we actually had an up day. But that's why we do that. That's why we look at opens, is because if we were to have shorted it at the open when they said it was down, and they were saying that it was still down, well, you would have lost money because the market actually went up, correct? So that's one thing that we have to try to do, is start looking at these opens and things of that sort. If you're, so in the previous day third, middle of the 1/3, so you would not trade. If it's in the middle third, of that particular market, no, I wouldn't, because you don't know where the sentiment is. It might be at the kind of the VWAP area, if you will. It's just churning around. That's one thing that, I have learned over time, I'll put it that way, is that when a market's moving sideways, you can go out and sell calls and sell puts against it, or throw condors on it or something like that, great. But if you're trying to buy it, you might be right and you might be wrong. why take a low odds trade? Why not take a higher odds trade? Or if it's trading down at the lows and can't break the low, yeah, you could try to buy it, bottom feed a little bit, and see if it bounces. Question is how big is the support that you're kind of trying to grab at here? So there's various ways of getting into a market. The previous gentleman was saying, no, anybody can click on a mouse and get into a trade. I agree with that. Question is how do you manage a trade? And how confident are you to think it's going to win or lose? I mean, you just might be taking a gamble just to see what happens. And I don't like those kind of trades. I like to get into a trade that I have high certainty of it working. So, but using these opens can help eliminate these gaps, if you will. So now, at 8:30 in the morning, we're going to start getting, we'll get the markets opening up. The one thing, we're going to get into talking about trading a little bit here. The one thing that I always go back and look at is what has the market done overnight, all right? I want to know how the market has traded throughout the night. Has it trended up? Has it trended down? What's the high and the low overnight? Because if we start taking out the lows of the world, and think about that, when we get our little ding, 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 ding here in the United States, the whole world's basically traded. We're the last ones to trade. And do we exceed what the world has done, or can we not exceed what the world's done? If we take out the overnight high and low, that means we have exceeded what the overall world has done, just like we've done today. We had that low down there at 2100, we broke below it, and we're still below 2100. But we've exceeded that low, so we've outperformed the world, if you will. So when we start looking, coming into 8:30 in the morning, I want to know where that high and low is, because if I get short and they go down there and hit the low and bounce, well, I already knew that there was a low there. They bounced before, why wouldn't they bounce again? But one thing, we want to use the first 5 to 7 minutes of past the open as just observation, let's put it that way. I mean, think about this. How many times have you woken up in the morning and listened to the news and they've said, Asia's down and Europe's down and this news came out and it was bad and this news came out and it was bad, and at 7:30 in the morning we had no CPI and it was this, or GDP or whatever it was. Well, they're putting a sentiment into people's minds. Psychologically, people are thinking it's going to be a down day, which isn't necessarily true, because once we get to our markets here, we might turn things back around. So, but when you see that coming into our markets here at 8:30, I'm see how many people have an account and a computer out there. They want to get rid of their, Merck stock, and they want to get rid of, their GE stock, and they want to get rid of this stock because they think the market's going to be down. And you have some people out there thinking, well, if the market's down, I want to buy this stock and this stock and this stock because it's probably at support. So you have all these orders flood into the marketplace right at 8:30, and the market just starts to jiggle. And you have no idea what it's going to do. But it takes about 3 to 5 minutes to get that jiggle out of the way, and then the market begins to trend, usually. And once it begins to trend, that's the trend we're going to start looking to trade. It's an early trend, but it's the first hand that the market has to tell you what it's going to try to do today. Because once you get the news out of the way and everybody gets their yah-yahs out right at 8:30, all of a sudden the market's going to have to make a decision. Is it going to go up or down today? Or at least up or down this morning? And that's what we're going to try to trade. So we're going to start watching to see how the market performs based off of the, here comes that word again, open. Is it above open or is it below open? And the next question is can it stay above open or can it stay below open? And that's what we're going to start trying to pay attention to. If it stays above the open, that means the bulls are stepping in, kept buying it at open, and trying to push things higher. If they can't get it above open, sellers are in there trying to push it lower, right? And that's one thing that we can start looking at each and every day, is who's trying to take control at that time. So, and it's not just one market, and this is the one thing that people get into in trading. People get very tunnel visioned, and I don't think they should be. You need to see a broad picture. It's very, very difficult to drive down the road looking just straight ahead and you can't see anything around you. You got to know where the other cars are. You need to know if there's a car coming in from this street over here and turning onto the street. I mean, you need peripheral vision. And it's the same thing in the markets. If you're just watching just the S&P futures and trying to think, well, it's moving down, let's go short. Well, what if you looked over at the Dow and the NASDAQ and they're rallying? Well, that S&P trade is probably not going to work out too well because it's going to flip around and follow the other two markets, and boom, you're going to get stopped out. So we're going to have to take a little bit broader picture here. And you'll have to try to figure out who's strong and who's weak. Because you'll have some days that the S&P may be wanting to move up, but the other markets are wanting to move down. And it all depends on the news that is out there and things of this sort. So we can start looking at the moves off of the open and based off of that. So when we start looking at 8:30 in the morning, we need to get past that little jiggle. We need to see if in that first 5 to 7 minutes they don't go up and challenge the highs overnight or challenge the lows overnight. But are they staying above or are they staying below open? And that's what we want to start looking at. Now, this trend that you'll see between 8:30 and 9 a.m. Central Time will start somewhere around 8:35 to 8:40, and it'll usually end somewhere around 8:50 to 8:55. You'll have a little 10 to 15-ish minute window that the market will move in one direction in, and then it will correct itself a little bit coming into 9 o'clock. And that's where you have to be kind of cautious, and if you know that, then if you're getting paid pretty well, you know there's going to be a little correction. You might just kind of hang with it a little bit and see what happens after 9 o'clock when they begin to move again. So, and really what we're doing is we're just slicing up 30 minutes here. I mean, 30 minutes of time is not very much, but we're really slicing up a 30-minute little window here to see if we can't make a little money in it, and it doesn't take very long to do so. So, I threw a couple of days in here just to kind of randomly do it. You'll notice on each one of these charts, and I'll go through those in just a second, there's a blue bar, okay? You have a blue bar on the top left chart, that's the NASDAQ futures. You have a blue bar on the top right chart, that is the S&P futures, and these are all 5-minute charts, okay? I did that just to kind of give you a better feel for what it did on a shorter period of time. Bottom left is the Dow futures. Again, blue bar. And then I threw the DAX in here also. Now, if you don't know what the DAX is like our Dow. It's just in Germany. This is theirs, like the German Dow, if you will. It's got 30 stocks in it. It's their largest industrialized stocks. It's just located in a different country. But since Germany is the largest economy in Europe, then we want to we want to kind of see what they're doing. You can watch, I guess, the Euro Stocks 50, which are 50 stocks across the, all of the European Union, I guess it is. But we like to watch the DAX just because it's a kind of a neat little indicator, especially early in the morning during the European trade. And you'll notice on this DAX that during this time it came up and re-challenged the open a couple of times but couldn't get back above it. Notice that? Didn't have anything to do with closes. They couldn't get back above that horizontal blue line on that chart. Now, the NASDAQ here dipped down, came back up, didn't quite make it back up to open. That's the top left chart. And then kind of tapered off a little bit. The S&P sold off pretty hard, never even made it close to getting to its open. Even the Dow took it down pretty hard, couldn't even get back up to its open. And this is a 5-minute chart. So if we can figure out a way after that first 3, 5, 7-minute time period to say, hey, they're not even getting back above open, then we have to try to figure out where to get in. What I'll usually try to do is let it go and do whatever it's going to do in that first 3 to 5 minutes, and then I'll see if they'll come back and challenge the open close enough that I can short it. In this case, just because it went down. But if you can go back up pretty close to open within a point or so in the S&P, within 10, 15 points in the Dow, within a couple of points in the NASDAQ, if it can re-challenge that open, I know then that I can sell it around there, put my stop above the high of that reference bar, and I'd give it a good point or so. So I'm actually risking about 3 or 4 points in the NASDAQ, which is only $80, or let's just make it 100 just to make it sound bad. The S&P, we're going to have to risk a couple, 3 points on it, which is going to be $100, $150. We can risk about 20, 25 points in the Dow, which is going to be about 100 to 100. 30, 40 bucks or something like that. So if we can get into that trade, we can minimize our risk because we don't have a whole lot to go to get to those highs. And if we break a new high, we know we're wrong, right? So yes, this is 8:30 a.m. Central Time. So, but I mean, if it makes a new high, we know we're wrong. But if I can get in as close as I can to that open, put my stop above the open, and then see if it starts drifting back off again. Even on this NASDAQ, if you got in at 26, we're down here at 11, you picked up about 15 points by just getting in and letting it swing back down. The S&P and the Dow here probably had a harder time getting into it because it never came back to challenge that open. The DAX here came up and slammed the open and kind of jumped right back down again. But the DAX is real thin, but it can move a whole lot. You can pick up 30, 40 points out of the DAX pretty easily. It trades, it's 25 euros a point in the DAX. The NASDAQ is $20 per point. The S&P is $50 per point, and the Dow is $5 per point. So you can take less risk probably out of the NASDAQ and the Dow just because, well, they're not going to hurt you near as bad if you're wrong. The S&P and the DAX, especially the DAX, could put you back in the words pretty bad if you're wrong. So I'm always trying to trade the Dow or the NASDAQ or something like that off of this trade. But let me show you another one here. Here's another one. This is on 10/28. This is last week. Notice something here. A little different picture, and that's why I threw it in here, just because you're going to see this sometimes. Notice the NASDAQ is going down and down and down, and I guess it didn't stretch the thing out. It kind of scrunched it up pretty bad there. But notice it could not get, it opened up and it just couldn't get back above that open. It just tapered off the whole morning. Now, granted, it only dumped off about 10 points in this whole move here. But it's a slow trickle down, but it never could get back above the open. The S&P dipped down. Even if you shorted it here at the open, it finally ended up paying you just because the NASDAQ was selling off. But notice they could not get back above this open. The Dow did not want to go down. It kept jumping up and 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 finally said, okay, fine, once the S&P started to sell off. But look at this DAX over here, and this is why the markets didn't really sell off all that well. The DAX started out down a little bit, but it wouldn't get back below its open and then finally just took off. So, and that's why we watch the DAX, is because it'll have influence on our markets. And when you're starting to try to figure out why aren't the markets just going down pretty hard or even rallying real well, go over and look at the DAX. A lot of times it's that DAX that's showing you, hey, you're not going to be able to go anywhere. All right. Another example, just to kind of give you several different pictures here. This is actually yesterday. We can look at this morning if you want to. And again, notice when they started out here in the first 5 minutes, they sold off first in this NASDAQ. S&P sold off first. The Dow, kinda. The DAX, kinda. But notice the Dow and the DAX jumped above their opens. The NASDAQ was like, I don't know what to do here. So was the S&P. But the Dow actually had a nice trend up. So once it took out that little opening 5-minute range, it went up, never got back below open, and kept going. The DAX pretty much did the same thing. It challenged the open a couple of times, but never got back below its open, so to speak, where you have the NASDAQ up below it, up and below it. Leave that alone because you don't know what it's going to do. S&P is the same way. But you have a very strong trend between the Dow, really, and the DAX a little bit. This one's a higher risk trade. Why? Because you really don't have the NASDAQ and the S&P saying, yeah, giddy up. We're going to go with you. But that's one thing that you run into sometimes is some markets being a little, they're not human, but they're a little bit confused, if you will. So, but that's one thing that I've always looked for is to see which one is trending better. So I always keep a chart on my screen of the S&P, the Dow, the NASDAQ, and the DAX. There. And also I'll have another chart. And in fact, if you want to, here, this is what my screen looks like. Now, this is kind of busy and everything like that, but you can kind of see that these are all 30-minute charts. But you can see based off, this is the S&P chart here. And in fact, let's do this. Here is ES. Here's a 1-minute chart of the S&P. This is just a 1-minute chart, so it's not a 5-minute this time. Let's go back in time. Let's go back to 8:30. There we go. Where is it? Here we go. So we have this open here, and let's just strike a horizontal line there. Sorry, line. There we go. And go boom. So that's the open. And you'll notice in the first 5, 6, 7 minutes here, it was jiggling around a lot and finally took out that low of that bar. And well, if they're going to take out that low, where's it going to go to next? 2100, remember that? So it came down, actually, here's your 2100 right here, broke below 2100, and look what it did with 2100. It couldn't get back above it, couldn't get back above it, and they shot above it. Then they held it as support. And they ran back up here, and then turned right back around, and boom, off they went from there. And they went down to 2093 here. But if you'll just watch that first 5 to 7 minutes, and if we change this, new chart. This is the NASDAQ, 1 minute again. Here's your open. Again, same pattern. Jiggle, 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 jiggle. Finally broke it and then came down. But, I mean, look at this move. It went from 4720 down to 4700. So you picked up, I don't know, somewhere around 15, 20 points on it. But you can, if you'll just be patient enough to let it get past that jiggle time, you can then start seeing what trend they're going to start pushing. And you'll notice each one of these, look at that, 851, and that's when they kind of quieted down. See how hard this moved between 840 and 850? All of these, you'll see that usually that 10-minute window in there, you'll see a pretty good push in the markets during that time period. And ever since then, look, they have not, well, you can see it on the 30-minute chart, they haven't been able to get back above the open. So that initial push, now remember this though, you'll find that we'll have news come out at 9 o'clock in the morning sometimes. So that initial push that they make, between 840 and 850 can be changed. Why? Because news is what? Market food, right? News is a market moving event. So you might have the markets reversed because we have news at 9 o'clock. We have, housing indexes, and you had the the Philly Fed survey and your ISM newses and stuff like that come out at 9 o'clock in the morning. So just because we push down during that time when we have news at 9, it might not last because the news might be positive, reverse the market, zing, off they go. So do beware of that. You always want to make sure you know when those newses are coming out. So that is one thing you always want to be looking for. So you were asking something here, global X high and low. Is this really the DAX open? That's the DAX US open. That's the US open. If you want to see the DAX open, here's DAX chart. Your DAX opens right there. This is the DAX futures. Okay, this is not the DAX cash index, this is DAX futures. The futures actually open up at 1 a.m. Central Time. That blue bar you see right there is the cash market open there in Europe. So when the DAX opened, it popped. When the cash market opened, they sold it off. They tried to move it back up, they couldn't, and then they just kind of sold off from there the rest of the evening. And that's what those are. That's the DAX futures, not the DAX. And actually, just last week, they came out with a mini DAX. And everybody's starting to grab it and everything like that. So, but anyhow, but that, let me go back over to the old PowerPoint here, get off the old live market. But look for that in the mornings, and this is based off the index futures. So the question is can you trade stock off of it? Absolutely. If you're wanting to trade, now the one thing, if you're going to be trading stock off this, if you're a stock trader and you want to kind of get in that first hour or the first half hour or so, the one thing that I would keep my eye on is something that can move, okay? And if something's going to move, it's going to have to be more volatile. And if it's going to be more volatile, well, you're not going to have Coca-Cola be volatile in that first half hour, right? And you're probably not going to see Pfizer or something like that move around all that much. So get something a little more expensive. Look for something that has at least a $2 to $4 or more average range in each day. And you can look at like a 14-day average range or a 20-day average range. If you're trying to figure out where to find that, go to barchart.com and look at something, and you'll find a sheet on there. Once you start looking at it'll give you the type in a symbol at the top. And on the left side, you'll see something like technicals or something like that. So you'll click on that. It'll give you, I think, the 9, 14, and 20-day ATR on it. So, and if you average them up, it comes out to about 14-day ATR. But if you want to find something that has at least a $2 to $4 range, that way it moves. So if you're an option trader and you're wanting to trade, options based off how the stock is moving, well, if you see something like, Amazon or Netflix or, whatever you want to look at, Google, if you're wanting to see what those things are doing, watch to see how they trade off that open. Once they begin to move, you can buy calls or you can buy puts, directional trade, right? Based off of that. But again, I want something that's going to move a lot. You're not going to probably get a whole lot of move out of Apple. It's a $100 stock, but I mean, and it can move in a day, don't get me wrong. A lot of days it's pretty quiet. And the options are going to be pretty cheap. If you want something that's going to move real well, grab a Netflix. Well, no, I don't know about Netflix, but grab Amazon or grab a Google or grab a Tesla, an IB or BIIB or something along those lines that can really juice up and get to moving during that time period. So, let's see. Somebody had a question here. I don't know how to make this little window bigger. It should be nice if I could do that. Afternoon, go all the way back up. Let's see, hold on. What determines when sometimes the market will do what it did this morning, drop down, and then in the afternoon go all the way back up? Well, think about this. When you're looking at how Asia and Europe traded, like yesterday, right? They were both down, and all of a sudden we turned around and took off. You have a couple things that happen in our afternoons. A, we don't have the influence of Europe or Asia or anything like that, moving us around. So our move in the morning might have been more influenced by what's happening in Europe there. When we go to lunch, there's really no reason for that trend to not continue. So it'll be a little slower. Once we get to the afternoon, the question is, since it's just us, do we merit being where we're at there? How's that? Or did we go up too high, or did we go down too low? And a lot of times you'll see a continuance of trend, and I'll say it this way, that we've had in the morning, probably up until 1:30 to 2 o'clock p.m. Central Time. That's somewhere around the 2:30 to 3 o'clock, I guess, Eastern. You might see a continuance of that trend up until then, but when we get into the end of the day, especially if we've moved up a whole lot, you might see a correction of that trend, kind of like we did yesterday afternoon, where we went up and made the highs, and in the last hour or so, they pulled things back down. Well, if you've been long all day yesterday, what's the only way to get out of your trade? Sell it, right? So this will turn back around and a lot of times sell back off into the close. Now, and you'll see if you're going to be, if you're looking at a 24-hour market, just very quickly before I go into trading, looking at options and stuff, because I only got about 15 minutes here. When we start looking at the 24-hour market, each of these reference bars or each of those individual time segments is, like I said, its own trading day. Now, just because we're up in our morning doesn't mean we'll be up in our afternoon, right? So when we start looking at those different time segments, you'll find that they have their own trends based off of what was ever happening around the world or here in the United States at that time. But you'll find actually a couple of other minor trend reversal times. One of them is 30 minutes before the U.S. stock market close. You'll see another one right around 6 o'clock in the morning. And why that is, and of course we do have news that comes out at 7:30 a.m. Central Time or 8:30 Eastern, where we'll have news kind of jack things around a little bit. I'm thinking, in fact, what is it? Friday, we have non-farm payrolls coming out, and the last time we had non-farm payroll numbers, they sold it off pretty hard. But you'll notice that when we got to our day market here in the U.S., they turned that thing right back around and it took off. Just because, well, the U.S. people thought it was a good report, the world didn't. So there it is. But what candle do you use to get in the trade? That blue one. You kind of break above or below, but one thing you'll want is all markets doing the same thing. Your best trade in this case that you're seeing on the screen here is the Dow, which is this lower left-hand corner, just because it really didn't dip down all that much. But notice when it took out the high of that little blue bar, this is a 5-minute candle, okay? So did that one, and so did that one, and so did that one. So they all confirmed breaking higher. Now, the S&P and the NASDAQ struggled with that. The Dow really didn't. It actually went up some more and kind of pulled back a smidge and then took off and went up some more. Even the DAX came back and re-challenged its open. But when you get in above here, your stop's got to go below those little lows. But basically, you're trying to figure out what it can and can't do. Okay. And before I run out of time, I want to get into stocks and options very quickly. Trading stock. Let's kind of do a little brain shift here. This isn't 8:30 in the morning. This isn't. I mean, we're going to see if we can't buy stock. All right. This is more of a swing trade. It's not in the small slice of life here a little bit. But what we're trying to do in any trade is minimize risk, right? Maximize reward. But that's the one thing that's really cool about options. Options are one of the greatest tools given to traders. If you don't understand options, I would encourage you to do so. Not complicated stuff. You don't have to get into all the butterflies and all the the condors, iron condors, and all the Christmas trees and all that good stuff. Don't worry about all of that. You need to just have a basic understanding of just options. When you buy a call, what's up? When you sell a call, what's up? When you buy a put, what's up? When you sell a put, what's up? And that's all you need to know. Because what we can do is we can use these options to minimize our risk and maximize our gains when it comes to trading stock. And it's very, 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 very cool. So very quickly, and I know this is going to be a review for some of you. That's fine. But very quickly, I want to just kind of run through options just to kind of give a real brief overview of what they are and what they can do for those of you who don't understand the options. Then we're going to go in there and look at a little trading stuff, okay? So we're going to talk about a call, and we're going to talk about a put. So let's go there. Call option gives the right but not the obligation to buy at a specified price. That's called the strike price on or before a specified date. People use options a lot in life, and they don't realize it. Insurance is an option. When you buy insurance, it gives you a right? And if you exercise your right, fix my car, fix my house, the insurance company has to do it. And you'll notice something. If you totally destroy your house or if you totally destroy your car, they pay you back a specific amount of money and no more, right? That's the strike price in insurance. But they sold you the insurance. So since they sold you the insurance, they are obligated to fulfill the terms of the contract. You have the right, not the obligation, to exercise your right, but if you do exercise it, they're obligated to fulfill the terms of the contract. And that's basically what options are. A call option gives you the right to buy a stock at a specific price called a strike price on or before a specified date, kind of like insurance. Insurance terminates and then you have to renew your contract and stuff like that. So when buying a call option, it gives the buyer the right to purchase the stock at the strike price. When buying the call option, you want the market to move up or the underlier to move up. If it's a stock, you want that stock to go higher. That's the only way you're going to get paid. So when selling a call option, this is naked, all right, or going short, I should say. It gives the right to another party. Now, this is the insurance company here. They're selling you the call option. Therefore, they are obligated to fulfill the terms of the contract. Now, when selling call options, there's two terms that you'll hear. One is a covered call. One is a naked call. On a covered call, you own the stock, all right? You can go out and sell a call against your stock, bring in premium, because when you sell something, you get money. And if the stock goes up and goes above that strike and they call your stock away, then you make money on the stock and you make money on the call that you sold, so you actually make more money. That's pretty cool. Now, naked calls, you don't own the stock. You go out and sell a higher call. If it goes above strike, you can end up short. Now, don't get all upset. being short in the market is not a bad thing. All right, you might hear it's a bad thing. People tell you it has unlimited risk and a stock can go to infinity. I'd like you all to do some research this weekend. Go find a stock that's gone to infinity. And in fact, here's something more realistic, okay? Go out and find how many stocks have actually gotten above 1,000, all right? Because you'll find there aren't many that get above 1,000. So really, can a stock get above 1,000 or can it go to zero? But for the most part, if you're using protective stops or some way of protection, I can short a stock at 100 with a stop at 102, and if I lose, I lose $200. I can buy a stock at 100, put a stop at 98. If I get stopped out, I'll lose $200. So as long as you're using good stop management, it doesn't matter if you're long or short. You can still lose the same amount. It just depends on what direction you're going to. So going back to naked call here. You don't own the stock. If you short the stock, you're going to have the amount of money in your account to sell that stock, or let's just say quote unquote buy that stock at that price. And that's what you'll have to have in there. But you can end up short the stock, so do be aware of that. Now, put options, very quickly, gives the right to sell at the specific strike price on or before a specified date. When buying a put option, it gives the buyer the right to sell the security, and you want the security to move lower. So there's only two things you can do in a market, buy or sell. There's only two directions a market can go, up or down. A call option, you buy it, you want the market to go up. A put option, you buy it, you want the market to go down. There. Now, remember, buying is the opposite of selling. So if I buy a call option and I want it to go up, if I sell a call option, which is the opposite, you want the market to go down. See? So, now, selling a put option, again, if you give the right to sell to somebody else, you must buy it from them. So, again, there are two things. There's a covered put and there's a naked put. Covered put, you're short the stock. You sell a put below it, it goes down there, they cover it, they call it away, quote unquote, and you buy it all back, but you still collect premium. The naked put, you're not short the stock, you go out there and you sell the put, and you actually have to end up buying it. Now, this is what's really cool about all of this. If I want to buy a stock, I can go out and sell a naked put. They're going to pay me money for that naked put. All right, that's what they're going to do. And I get to collect that premium. If they don't go down and they go up and that put becomes worthless, that means I sold it for $1 and it goes to zero, so now I get to pick up the whole $100 that I sold it for, then so what? I get the $100. That's the end of it. However, it might be assigned to me, but if not, then I get to keep that premium. If I get exercised, say I sold a 100 put, it goes down to 99, I get exercised, now I'm long the stock at 100. I picked up the stock, but I also picked up the premium from the put I sold, okay? Now, I will then flip around and go a strike or two up and sell a covered call against it. Again, pulling in premium. So I pulled in premium off the put I sold. I'm pulling in premium off the call I sold. Now, what can I do? I can add those two premiums up and say, hey, I brought in this much money. I know then that I can risk that much money on a stock that I'm long. And if I get stopped out, what? I lose nothing. Now think of risk reward. Risk zero to make money. Hey, best risk reward you can have, right? One thing about risk reward, I got 4 minutes here. One thing about risk reward is that a lot of people think wherever their stop is and wherever their profit target is risk reward. I disagree, because I could go out there and say, well, what if we just bought the S&P at 92, 2092? I'm going to put a 1-point stop on it and put a 10-point profit target on it. So I'm risking 1 point to make 10. You think that'll work? I don't. I think it'll stop you out because the S&P is going to jiggle around. So the thing is what are the odds of the trade working? And that's the biggest thing you have to look at, is what are the odds of the trade actually working out. Now, if you're down at the lows and you think you can risk a little bit because they hadn't been able to break the low yet, now that I can agree with. But if you're just randomly throwing in, I'm putting my stop here, you're telling the market what you want the market to do. How well does that work out? Not very, right? So we have to do what the market tells us to do. Now, on any stock, and that's what this little second line is on this slide, I don't like to risk more than 500 bucks. On any stock, I don't care if it's a $50 stock or it's a $500 stock, I don't like to risk more than $5 on any stock for every 100 shares. So if I can sell enough premium to finance that 500 bucks, that's awesome. But you should be able to bring in enough premium on these things to where you shouldn't risk more than 100 bucks or so. And sometimes you'll find out that the premium that you bring in where your stop is, if they stop you out, you actually make money just because of the options that you sold. It's really awesome. So, so profit, premium from the naked put, premium from the covered call. Difference is between the entry and the exit of the stock, plus those two things. So you can actually take a let's just make it awesome. You sell a 110 put. Say you bring in $2, you immediately flip around, sell a month or two out the 120 call. Let's just say you bring in $1 or $2, so you total of $4. If it goes up and calls it away, you make $1,400, right? Because it's $1,000 from 110 to 120 plus the 200 on each option. So there's $1,400. If it goes down and if it stops you out, let's just say you put a $4 stop on it, so you're risking 0 to make $1,400. That's not so bad. Or even if you gave it a $2 or $3 stop, you still end up making $100. And the name of the game is to finance the stop. In other words, manage risk. But if I can finance the stop, it's really pretty cool. But I can sell puts on stocks that I want to buy. If I'm filled, sell calls against it, use the premium from the two to finance my stop, and at least reduce how much I'm going to have to risk. So if I bring in a total of $4 and I'm still going to use a $5 stop, my max risk is what? $100. And that's what we're looking at. Here's a real quick example, because I am just right up next to the neck here, I believe. This is O'Reilly. This is O'Reilly Auto Parts. I don't know if you ever looked at O'Reilly. You can do this on any stock. I just did this one because I actually did this trade on this stock. But it's a pretty expensive stock. It's as of today, it's right around $270 a share. But it moves around quite a bit, and it only has monthly options. Now, if your stocks that you're using have weekly options, use them, especially for entering into the trade. Now, give it a little time. Here it is, Wednesday, right? I wouldn't be doing this Friday's option. No, unless you're doing it, at the money, and you can actually pull in some pretty decent premium just because you want to buy the stock right here. I'd give it an extra week so you can pull in some more time value. And then start going from there. But you can only do this with optionable stocks, so not all stocks have options. Beware of that. So this is a chart of O'Reilly. And just to show you what I did, and I took some heat, I sold the 250 when we were coming up here to this 250 area. We came up to this 252, 253 area. They pulled back. So I sold a 250 put on it. And of course, my thought is this thing can move around quite a bit. If I get exercised, then, well, I'll see if I can't put my stop down to like 244, something like that, and get away with it. Well, of course, they jumped back up here a little bit, and then they pulled back down. Like I said, I took some heat on this a little bit. But it never got below that 244 area. I got exercised, by the way. And from there, it was just kind of pulling along. And I went out to sell the 260 call, but guess what? It had never been to 260 before. Well, if a stock's never been to a specific price, what are the options worth? Zilch, because, well, it's never been there before. Well, it made a pretty good push up here to this 260 area. Now I can probably sell a 260 call. So I thought, well, I'll make sure it stays up here. I'll just sell a 260 call. Well, they snapped this thing up. So I got lucky. So I sold the 270 call on this day here, lock in an extra little bit of premium. Plus, I picked up 11 bucks on that call, but I did the December call. So I still have a month and a half here for them to stay above 270, but I picked up $11 on that call, $4 on the put that I sold. So just in the option, I got $1,500. My 244 stop doesn't mean spit now. So if it stops me out, wow, I make $1,000. If they call it away from me, I make 1,100 bucks on the call, 400 bucks on that one. There's 1,400 plus the $2,000. So I've got 3,400, or I make 1,000 now. That's what I'm talking about. You can do this on anything. And even I took this snapshot this morning before I started doing this thing. This is O'Reilly. Look at this. This is just this week. You can sell the 260 puts for right now at right around $1.35, $1.40. Right now we're at 271. If you want to give it a little bit of room just to see what happens over the next couple of weeks. The December puts, you can get about $4 for them. And looking at this, right now we're at 270. If you look at next month's 280s, they're going for about $4 also. So you can pull in usually somewhere around $8 on doing the call and the put, which more than finances my $5 stop on any stock if I get long. So, and that's the thing. The options allow me to do that. If I'm just trading the stock, it's pure risk and hopefully pure reward. With using the options, I minimize my risk, in fact almost eliminate it, and I can maximize reward, and if I get stopped out, I still don't get hurt at all. So, can you sell spreads instead? This strategy is specifically to take the stock. I've never tested it with doing spreads because I hate spreads. I am not a spreads person. I don't like to pay anybody for anything. I want them to pay me, and that's just how I do it. I will sell calls against something. I will sell puts against something. I can't even remember the last time I ever did a spread, but I have done them. So to me, they just limit you. I don't like being limited. That's what I don't like about them. But if you can figure out, some way of doing that, I mean, there's some very smart option people out there. You can probably figure out how to do this and, get your delta neutral stuff and all that good stuff. I really don't care for any of that. I just know that I can sell a put, bring in money. If they exercise me, I wanted the stock anyway. So, but do you sell both? No. Time out. Do not sell both at the same time. Sell the put first. And if we're in a down market, if you want to short the stock, sell the call first. There. I mean, we've been in an up market for 5 years, so I've just been looking to sell puts here lately. If this market ever turns back around and starts selling back off and all that good stuff, by all means, do this opposite. Sell a call, try to get short the stock, and flip around and sell a covered put against it, something like that. But a lot of people's brains don't understand that, but it works the same way. But anyway, sell the put first. If you get the stock, then sell the call, okay? If you don't get the stock, keep the premium, and then go out and sell another put and see if you can't get it the next time also. You can end up, now, here's the bad thing about doing this. I'll tell you the downside to this real quickly, since we're at 12:20 here. Okay, the downside to this strategy is you don't get the stock and it leaves you in the dust, and then you have that left out feeling. Believe me, it'll do it to you sometimes, okay? You'll sit there and go, man, I really want to buy Disney at 110. So you sell a 110 put, and next thing you know, by the end of the week, it's up at 115. You're like, okay, I'll sell a 115 put. So you sell a 115 put, bring in premium, and then all of a sudden at the end of the week, it's at 120. Well, if you would have just bought the stock at 110, you would have picked up $1,000, right? It'll happen to you sometimes, all right? It will. But I like doing this strategy on all kinds of priced stocks. I do it on Williams-Sonoma, which is like a $70-ish stock. I do it on PNC Bank, which is right around 85 to 90 bucks, depending on where it is today. I do it on, I've done it on Apple quite a few times. Netflix, I've done it on Netflix. I mean, like I said, it doesn't matter if the stock's 500 bucks or if it's 50 bucks. You can do this. Just beware, you want enough premium to finance your stop. So some stocks that are $80, I mean, look at like John Deere. it doesn't move all that much, so the premium is going to be very low. But if you look at something, outside of that a little bit, you'll Under Armour. Under Armour is going to have some pretty good premium because it can move around a lot. So even though it's under $100, or last I saw it was, but look at the stocks and what you can get for the premiums. So somebody asked me something here, I believe. Only covered calls, so what can you do? It's not only, IRA you can not use. Oh, yes, you can. You can sell all the puts you want in an IRA as long as you have the money to buy the stock. If the company that you use does not allow you to sell puts, I mean, what's the difference between selling a naked put and putting in a buy limit on the stock? What's the difference? What's the difference between selling a naked put and putting a buy limit on a stock? Does anybody have an answer to that? What's the difference between those two? Very good. The biggest difference is they pay you for selling the put. Besides that, nothing. So if your IRA people won't let you sell a naked put to buy stock, fire them and find somebody who will, because it's perfectly legal. Perfectly legal. So now you can't do naked calls because you end up short, right? And somebody was saying, can you buy a put? Well, in an IRA you can't, because you can end up short. Anything that's going to make you end up short is dangerous in an IRA. But if you're selling naked puts to buy the stock and sell covered calls against it, totally legal. It's awesome. Like I said, I don't like to risk more than $5. Or go look at your option strikes. Go 1 strike or 2 strikes out. Pull up a daily chart, and you'll probably find that they've got pretty good support at 1 strike or 2 strikes out. Put your stop there, below that little area. That's the easiest place to put your stops. But just look at those option strikes. But remember, you're bringing in options to do that. Can you please answer? I'm sorry, I got this little itty-bitty window, and I'm trying to scroll around in it. That was Jack. Jack, where's your question? Let me see. Here we go. How does this relate to trading in the first half hour? Well, like I said, we were shifting our brains going from the first half hour small slice of life to swing trading stock. If you want to, you can use that first half hour to see what that stock's doing. If you're wanting to buy a stock, here's O'Reilly here. If you're wanting to buy it at 260, well, maybe the first half hour they sell the thing off, then sell your put. I mean, you can use the same thing. I'd just be looking to try to get as much premium as I could out of the puts. I think that answered your question. I hope so. So, and while where's my little here? Going through all this, I'm not going to make you pay for anything. I'm not going to try to sell you anything. And one thing that if you want, each and every day I put out a trade of the day. If you want to follow along with me, you can click, take that little link right there. I don't know if you can click on that or not. I assume, I don't even know if I can highlight this thing and put it over there. But if you, and I think you can click on that. I don't know if you can or not. But if you register for that, each and every day I send out an email to people, and I alternate days. I'll look at futures one day, I'll look at stocks another day. Future stocks, future stocks. On the stock side, I'm looking at both the equity and the option, because people are different. Some people are just stock traders, some people are option traders. On the future side, kind of doing the same thing. But I think people ought to kind of learn various markets, so I kind of alternate between them. Last month, I did Amazon and coffee, and Williams-Sonoma and live cattle, gold, Costco, Gilead Sciences, sugar, Nike, Kimberly-Clark. I do, like I said, I do something every day. But if you're interested in doing that, feel free to click on it, join, and kind of follow along a little bit. But I will send that out somewhere between 6:30 and 7:30 every morning. That's Central Time. And you can click on it. You'll see the video or whatever it is, and you can trade along or not. Doesn't matter. But the history's been pretty good. We've done real well with it, and but I've been doing this for about 3 months now. And have a lot of people following along. But if you'd like to follow along just to kind of kick the tires and see what I do and how we trade and all that good stuff, give us a feel here and let me know. So, but any other questions, comments, how-tos, what-fors, whys? Are these trades of the day long-term or short-term? Good question. I would say most of them are swing-type trades. Sometimes I'll be in them for a good long time, month or so. Sometimes it's kind of a shorter-term deal. I might look to sell a bond futures call or put that expires in 2 or 3 days. So kind of shorter term there. Nothing that I have done is on purpose an intraday trade. I'll put it that way. Sometimes it ends up being that way, just because it moves so much in a day. But I'll tell you where I think it can go hit for as far as targets. And it might take it that day, and it might take it a month. I don't know. So that's one thing I'll say. Do you buy puts or calls? Yes, you can do either one. That is, I think I got that in there, didn't I? Yeah, that is my email address. I thought I had my email address in there. But if you'll send me an email, my email address is smithga@dtitrader.com. But we're at 12:30. Sorry about this. Yeah, it's not even typing. So, but smithga@dtitrader.com. If you don't get it, let me know, and I will get it to you. So, and add you to the list. So, Dan, thanks for everything. Sorry, I went an extra little 30 seconds here, but thanks for having me in. You all have a great and wonderful day.